All right, everyone. Welcome back to another episode of SaaS Buyers Club. I'm your host, Omeed, and I'm a corporate lawyer that helps founders with starting their business, scaling their business, raising venture capital, and exiting. So pretty much anything that has to do with contracts is what my law firm helps with. And I love helping founders make money and be successful. And I started the SaaS Buyers Club podcast because I believe that helping founders get value of any sort from the world's brightest minds and experts will help founders increase the value of their business, which ultimately increases the exit value of the business. And so with that being said, I'm pleased to introduce Morgan Polotan. And Morgan is a venture capital investor, ex-Monashee, B Capital, Comcast Ventures, Bloomberg. What a history and background. So Morgan, thanks so much for joining.
Thanks for having me, Omeed. I'm excited to jump in.
Absolutely. So yeah, a lot of interesting things that you've done in your history. Tell me a little bit more about you and what you've done.
Yeah, absolutely. So, I've been a venture capitalist for about 10 years. And, just a quick history on my background. This is not in my life plan. I had kind of a winding, non-traditional journey into venture. I was an undergrad business major. I knew I liked technology and I liked investing. If you asked me who my two role models were at probably 12 years old, I would have said Bill Gates because he creates new technology and Warren Buffett because he invests in things. That was about the extent of my knowledge. I didn't really know what venture capital was at that point. But after graduating college, I took what I call a creative gap year in LA. I acted for a year, kind of had a whole Hollywood experience, which is really fun. Not on my LinkedIn, but some people go like backpack Asia, and I did that. After LA, I spent a couple of years in DC. I was kind of craving the intellectual stimulation that I had in college, and I really wanted to ask myself or answer the question for myself: what is my life purpose? What is the one thing I want to optimize for over the remainder of my life? And through my time in DC, I was working for a nonprofit foundation called the Koch Institute, and spent a lot of time reading about entrepreneurship, markets, and economics and that, how that all works. And what I realized is that the number one driver, the living standards of humanity over time, is the commercialization of new technology. And so I realized that whatever it is I did, I wanted to be close to helping new technologies commercialize and mainstream, right? So the first iteration of that for me was moving from DC to New York City, and which is where I grew up for most of my life, teaching myself how to code and becoming a software engineer and I was very passionate about ed tech. And so I worked for an ed tech startup that I was a fan of called Thinkful. And that was my first kind of attempt to there's technology and startups that are, impacting the world, going to create things that will improve people's living standards, bringing down the cost of education while keeping the quality high. And I want to work as an engineer. I want to know how the technology works under the hood. Frankly, it was also easier to get a job as an engineer versus just a young, business grad without any real definite skills. So I did that for a couple of years, and this is a kind of the segue into venture. What I realized is that I was probably the most social engineer out there, probably to the chagrin of many of my fellow engineering colleagues, where my idea of fun was not only writing code, which is awesome, but also grabbing coffee with every engineer working at every different startup, asking them, "Oh, what are you working on? What are you building? What's your company doing?" etc. And that was all my personal time, right? And what I realized at that point, and I realized this because I happened to hear about a job at Bloomberg Beta, which was the first venture firm I worked for. I was teaching programming nights and weekends at General Assembly outside of my regular job. And my co-instructor, told me about this role that he saw. And he's like, you should really check it out because it's an investing role. But they don't require any prior investing experience. In fact, they're looking for someone with a technical background. Because at the time, Bloomberg Beta, and this is still true today, I was investing in a lot of, future of work was a big theme. And it was investing in a lot of stuff that was, technical, like for developers, for engineers, and they wanted someone with that background. So at the time, I was interviewing to be the first engineering hire at another startup in New York called Timescale. It's a database startup. So I wasn't really trying to get into venture, but I figured I'm going to make my interview process competitive. I'll throw my hat in the ring in the Bloomberg Beta role and, try to speed up the Timescale interview, essentially, with competition. I was lucky enough to get both roles. And so then I had to kind of introspect a bit of okay, am I going to keep going down the engineering route, or should I consider this thing called venture? And I, basically came to the conclusion that because the role was a 2-year role, right, with a natural endpoint, which is how a lot of junior investing roles are structured, there was a natural exit point. So at worst case scenario, I didn't like it. I wanted to go back to being an engineer. I would be rusty, but I'd still remember how to code. And so I decided to work for Bloomberg Beta. It was a great experience. I kind of fell in love with investing because it was the only career I've had up to that point where I would get paid to go do what I was doing in my personal life, which is go learn about all these interesting startups. And I was like, wait, like that is part of the job, to grab coffee with all these founders. Like that sounds awesome. So I stuck around, and after the 2-year role ended, I went to work at Comcast Ventures, spent about 3.5 years there, kind of expanded my purview as an investor. Bloomberg was B2B and seed only. Comcast Ventures was stage and sector agnostic. So, was investing in everything from enterprise to consumer, multiple stages, pre-seed, like Series C, software, hardware, frontier tech. Like it was very, a great place to kind of learn the ropes, learn diligence, and really learn how to be an investor. So I spent 3.5 years there. I then joined B Capital, which is a global late stage venture firm founded by Eduardo Saverin, who's one of the co-founders of Facebook, now Meta. If folks saw The Social Network, he was like the guy who got kicked out of the company, but ended up doing really well. Got some shares. He's okay. So he started this firm called B Capital, and they were like a late stage venture firm, but they were starting an early stage fund called the Ascent Fund. So I joined as like the first, non-partner hire as a principal and then senior principal there. And that was cool because I got to apply what I learned at Comcast Ventures, but also in the context of like, helping to build a fund, which is another kind of level of just like evaluating deals, right? So I spent a couple years there. It was really awesome. And I ended up getting recruited by Monashee, which is a hedge fund, after 2 years to lead, their crossover investing. It's kind of more like late stage venture. And then as very recently, I'm now going out on my own and doing something new. So I can't talk too much about it yet, but I'm excited about the next phase.
Yeah, I noticed that on your LinkedIn, it kind of ends at Monashee. So I was going to ask you, what's happening now, but it makes sense that, you're in stealth. So keep an eye out, everyone.
What I'll say is that I've been spending a lot of time advising companies, just a lot of times founders I've known for a long time who I've always kind of wanted to partner with them in some way. In some cases are prior investments, some cases they aren't, but that's been a lot of fun, right? Just taking everything I've learned over the past 10 years, unbundling it from the investment, right? Because typically in venture, you advise after you invest, and you can only advise in companies you invest in. So unbundling it has been fun because I can work with companies across all stages and sectors, which, for me, variety is the spice of life. It's what I get a kick out of. So yeah, it's been an exciting time.
Awesome, man. Thanks so much for sharing. Appreciate that background in history and, the journey that you've been on up until this point. And super interesting that you kind of went from software developer to VC and then climbed the ladder, in the VC space. And you share a ton of information on your social channels. That was actually how we connected. I had seen, all the shares that you were making on Threads, and just, I
think you were like literally the first like person to ever comment on my threads. I was like, is anything going to happen on this platform? I have no idea. Like I'm just posting. It's like crickets. So,
but, and then here I am like, da, 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 da. Yeah.
I was excited. I was like, yeah, this is great.
And you share a lot of valuable information. So for everyone out there, his contact information is going to be in the show notes. Make sure that you follow him because he shares, the nitty-gritty insights of the investing world. And you have a lot of experience meeting with founders. Obviously it sounds like you're very passionate about, meeting founders, advising founders, connecting with founders, getting coffee with founders. You're spending time immersed in that world, and you have the technical background yourself as well. One of the things that I'd love to talk about with you is like, what are some of the things that founders most often ask you? Like a few questions that you see time and time again, from founders that, maybe they need support with, they need guidance with regard to, what are the most frequently asked questions?
Yeah, great question. I mean, I would categorize this all by saying that the number one thing founders really kind of want from me is getting into the head of the VC, right? The VC persona, right? If you will. I think that there's like this interesting relationship between founders and investors. Maybe it's true in all kind of asset classes, but especially true in VC, at least in my experience, where founders, of course, do need to raise capital, right? If you're creating a venture scale business. And so there's like this kind of interaction that has to happen often multiple times throughout a founder's, career. And yet while VCs do, post content and they have educational things and they're on podcasts and they do this kind of stuff, it like the kind of content, VCs tend to share publicly tend to be more around, how they're thinking about the world and in order to source deal flow, right? It's not as much, let me open the kimono of venture capital and explain everything about, the VC's incentives or industry in a way that really educates founders. And, the reason for that is, of course, that there's not really that much of an incentive to do that, right? I mean, I only started kind of being active and posting daily on social media and opening the kimono once I was no longer at a firm, right? Because, it's kind of like there's like this little club that is a bit of a black box, and, there's informational asymmetry, which creates advantages when you're at the negotiating table with the founder. I mean, that's just the reality, whether kind of VCs acknowledge it explicitly or not. And so what I really wanted to do was, open that kimono and kind of let founders in to like, okay, let me just be brutally honest, about this is how VCs think about everything, right? In terms of evaluating a company, this is what they like, this is what they don't like. And I mean, we could spend hours on that, right? I would say most of it is around, of course, founders who know that they are going to raise and they're like, how do I tick the boxes, right, of investors such that I have a compelling business, right, that's hitting the right metrics, the right milestones based on my business model, my sector, et cetera, such that VCs will get excited about the business itself. How do I then package that into a narrative that is compelling, right, which are two different things, right? You can have a business that's clocking in all cylinders and checks the boxes, but then the narrative completely falls flat. You're not saying the right buzzwords. You're not using the right, not jargon, but like you're not using the right terms.
You're not speaking the language of the VC.
You're not speaking the lingua franca of a VC, right? And there's certain ways to present your story that resonate and work and certain ways that do not. There's, red flags and green flags and yellow flags and orange and all the in between. So that's probably like the second biggest thing, right? So if we talk about like, okay, the business itself, the narrative, and then I would say like the third thing is around kind of the process of raising capital, right? Where, this is something that most founders do several times in their life. Whereas like, of course, VCs are going to be part of that on the other side of the table hundreds of times over their life. So again, there's just like an information asymmetry. And so that's probably the third thing is like, what's the best practice in terms of actually structuring a capital raise that has the best chance of succeeding? That's probably the third bucket. And then I would say the fourth bucket is everything from kind of negotiating, term sheets and understanding, the different financing documents. There's definitely a lot of overlap with, kind of what you do and like lawyers and everything. So that from like a VC perspective, which can be different sometimes from a legal perspective, all the way to like post-investment, like managing the board and like how to interact with, existing investors and, understand your capital structure and that kind of stuff. That's probably the fourth.
Okay. So what's your average raise size, just so we get a feel, in your career, what would you say like average capital raise size has been?
So in terms of my investing, it's like seed series A is probably like the most common, right? So like
1 to 15 million, something like that.
Yeah.
Yeah.
The companies I advise now are like kind of in that range too.
Gotcha. Yeah, that's like pretty much the same range that we operate in as well. So the 4 buckets are the actual business, like what milestones and metrics, so on and so forth, telling the story, structuring the capital raise, and then, managing kind of the post raise and just in general, VC management.
Yeah. Term sheet and like kind of board is like that fourth.
Yeah. Okay, cool. So what would you say is like one question that you get the most in terms of that first bucket, which is the business itself?
Yeah. Is my business a venture scale business?
Mhm.
That's like the number one. Whether it's mentioned explicitly like that or not, like that's the number one question. And, I think the reality is that if we look at like all small businesses, right? Most businesses are not venture scalable, right? And they should not raise material amounts of venture capital. It's extremely not clear, I think, to many founders about what is venture scalable and what isn't. And frankly, it's not clear to many VCs what is, venture scalable and not. I think I experienced this and learned this lesson very, very clearly in the 2020, 2021 kind of COVID-induced zero interest rate policy bubble, where it felt like everything was a venture-backed company, right? Or if they weren't, every company was getting venture capital, right? Even whether or not it was venture backable or venture scalable and fit the venture model was a different question.
Mm.
And I think since the market has corrected, there has been this kind of realization and shakeout of like, okay, wait a minute, let's go back to first principles. Like, what is venture capital? What is it designed for? What kinds of companies should raise venture capital? What does it imply for a company and a founder if you do raise venture capital? And, then you kind of sort yourself out into the right buckets. And so what I tell founders is venture capital is essentially, it's early stage, high risk capital, right? So what does that mean? Like the venture capital model, right? The traditional venture capital model is designed from a portfolio construction perspective, right? To accommodate a high loss ratio, right? That's kind of like the first thing to understand. So how does a VC still generate, let's say, a 3x gross return for their LPs if 50% or more of the investments it makes is going to go to zero, right? Or between 0 and 1x? Like, how do you actually do that? Well, you need outliers, right? You need one or two companies to really hit a grand slam, right? This is kind of like the kind of paradigm in VC, and I'm really talking about early stage VC, not kind of Series E VC. The paradigm in early stage VC that we would always ask around every investment community I've been a part of is, can this one investment return the fund, right? So we may be investing 5% of the fund, but can it return 1x the entire fund, all the committed capital we have for this fund? And if we don't believe that it can, then it generally doesn't pass the bar because we know we're going to have a lot of loss in the rest of the portfolio. Okay. So in that paradigm, you need the companies that work need to get big enough, fast enough, right, to be an 100x type of outcome, right? And what kinds of companies get big enough, fast enough? They're ones that can grow, there's this kind of notion VC, triple, double, double, double.
I was just
right?
thinking that. Yeah.
Yeah. As a rule of thumb, right? Where like that, if a company can triple revenue, double, 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 that's essentially like a 5-year game plan to get north of 100 million, right?
That's the scale that VCs are looking for companies to grow at.
And that's even an outdated growth expectation, because that used to enable you to exit via an IPO. In today's market, you need 5x that revenue to exit. Now we'll see how that changes, but like the main insight is you need a company that can grow extremely fast, right? If you looked at some of the companies, and again in this past kind of bubble, like they were growing way faster than triple. I mean, I saw companies growing 10x revenue year over year, right? And when you look at like OpenAI, of course, is like, still doubling at 5 billion revenue. It's crazy, right? And these are the kinds of companies that venture is made for and built on. So it has to grow really fast, get really big, and then it has to capture a lot of the value in its market. And this is really the dynamic of a winner take most market, right? If you have a company that can grow really fast, can get really big, and then capture most of the value in that market, right? Kind of monopoly-like effects, like 50%, like number one leader will have 50% of the market or more. Think Google in search or Uber and Lyft in ride sharing, right? These kinds of examples, because they benefit from some combination of monopoly effects, network effects, and economies of scale, and et cetera. Those are the businesses that are like picture perfect for VC, because if you're operating a startup in an industry and a market like that, the economically rational thing for you to do is to optimize for growing as fast as you can. The unit economics still need to be positive, but assuming positive unit economics, grow as fast as you can, burn cash for years at the company level, and just grab as much market share as you possibly can, because 80% of the spoils are going to go to the number one category leader. And the number two player might have 5%, 10%, right? I mean, Google's like 95.5, right? I mean, Uber Lyft is maybe something like 70-20 or something like that, right? So it's economically rational to do that. And so if you need to burn capital for 7 years straight, then who's going to fund that? Like a loss-making enterprise for that long, it's going to be venture. Like that's what venture's made for.
But don't you think most founders operate under the assumption that they're going to, capture the majority market share? And I think, and I'm curious about your thoughts about this in terms of most founders, if you ask them what their problem is in their business is, capital constraints. And the reason why they're not growing is because, they don't have access to capital. And if they just had access to the capital, then they would grow the way that they need to and exponentially. And most founders have a vision, at least, especially in the early stages of, building, that next giant business. So how should founders the very crux of this conversation is know whether you are a VC backable business or not. But I think the problem is that founders, because they may be visionaries, for example, and you're not going to go into anything if you don't think that you're going to, hit it big. And a lot of ideas start from the place of, oh my God, this is the best idea. It's going to be $1 billion idea, for example. Yeah. How do you balance those things?
It's a great question. And I would separate a couple concepts, right? A venture backable business is one concept. A big business that can be successful by almost any definition of the term, that can generate life-changing financial outcomes for a founder. Those are two separate things, right? So I think that's maybe the first thing that I want founders to understand is there is absolutely nothing wrong with building a business that grows at, maybe in the early days, doubling ish. And then, in year 3 or 4, it grows 30 to 50% a year. And you only raise 10 to 20 million. And then you build it up to 100 million in revenue over time. And that's a 5x multiple. And you all of a sudden you own 40% of a $500 million business. Like that is, excuse my French. Can I curse on this?
Oh yeah, absolutely.
Fucking amazing, right? That is fucking amazing. So I think this thing gets confused is like, oh, if I want to build a big business and be really successful, it has to be a venture business. And that's not the case. There's a whole asset class, which is 10 times bigger than venture, called private equity, which, operates in this kind of world, right? Private equity is not a, triple, double. They're like, get to profitability and, we want to have cash flow and, but they're huge businesses, right? And they often operate in different market structures, right? Where the number one player in like a freight warehousing business that is like a target for private equity does not have 80% of the market. The number one player may have 5% of the market. So it doesn't make sense to over optimize for growth because there's no monopoly effects in that industry. So, that's the first separation I want to make. And then the second is like, whether you're venture backable or whether it's more like a private equity type business, that is completely separated from the founder's vision for how big the thing can be, right? It is a market structure question and a kind of company analysis question, right? I think that's the thing that I want to kind of get out to founders is like, and of course, this is a lot of conversations I have with founders is exactly around this, right? Because, you can introspect all you want, but like ultimately it helps to get an external perspective. Is my company a venture? And venture scale is probably like the wrong word because that implies bigness, right? Is this a fit for venture capital or is this not a fit for venture capital? Because while both can be big, they imply two very different business strategies and capital raising strategies, right? Because I said if it's a venture capital business, then you burn cash, optimize for growth, and really try to grab that 1, maybe 2 market share position. If it's like more of a private equity type business, and I'll get into like, there's a lot of industries that I think are more like this, right? That ended up raising venture, but probably shouldn't have. Then you don't maximize growth and burn cash for years. What you do is you raise enough to get started. you get to profitability as quickly as you can at the company level. And then once you're at profitability, depending on your business, you'll be at some scale. And then you control your own destiny and you have optionality. And then you raise capital if you can deploy that capital at high return, right? Relative to the cost of that capital. And it's not just like raise to maximize growth. It's okay, well, it's like a capital budgeting exercise essentially, right? And it's not to say you never raise capital, but you're just much more considerate about it. And that's the strategy one should take if you're in kind of that private equity realm, right? So maybe the last thing I'll say, or comment, maybe I'll turn the table back over to you is like, and I had a LinkedIn post, I think a few days ago about this, where I was like, I gave the Google, the search and the ride sharing example as like two, like those are venture industries, right? Other examples are, AI, I think pretty clearly has monopoly effects. I mean, we can debate that, but like, I think it's pretty clear that there's a winner take most market there. So, great fit for venture, a lot of stuff around that has proprietary technological IP, right? We look at NVIDIA and like just frontier tech in general, SpaceX and Tesla and these kinds of things that, are, once you do the hard thing, there's like this huge barrier to entry around that is very hard for others to cross. So like, these are all kind of venture examples. And then you have a lot of other examples. What I put in my post is like, this is SaaS Buyers Club, right? Like you're kind of run-of-the-mill SaaS company that doesn't have network effects, doesn't have, a huge kind of monopolistic type mode to the business. Some SaaS businesses do, and others do not. Again, there's nothing wrong with either. They can both be really successful businesses. But if you're in an industry or in a product category where the number one leader has 5 to 10% of the market, like that's not a venture market. So you should act more like a private equity company. Fintech companies that take like balance sheet risk and are lending, like, I've seen this happen so many times where if you raise venture in a company like that, and then the expectations of your venture investors are to grow triple, double, you end up degrading the credit quality of your book, and it just doesn't make any sense, right? Real estate companies, WeWork, I mean, come on, this is like the biggest example, right? WeWork could be a great real estate business. That's probably could have been a $10 billion business, right? The incumbent region was like 2-3 billion. It was old and boring, and WeWork was cool and new. That would have been a great business, right? Adam Newman could have, he walked away with $1 billion anyways, but like, you could have owned, again, 40% of a $10 billion business, been a billionaire. It's crazy. Instead, it was treated like a tech business, bid up to 40 billion with like tech revenue multiples. Doesn't make any sense. So, there's all these kinds of businesses, consumer brands, CPG, the kind of Warby Parkers and, of the world. Again, great businesses, but like, is the number one glasses company have monopoly effects and own 80% of the market? Like, no, there's a long list of these. And I think that's like, in that first bucket, right? That's kind of like the number one question, because that creates path dependence. That you need to,
you get to identify which direction to go. That's the best fit for you. But I think that one of the challenges that a lot of founders face is where they do identify that or maybe, the market places them in a place where they're not VC backable. The problem with PE is PE doesn't do a lot of early stage investments. They really want to see that the business has been proved. And so there is an investment class that's missing there, that they have to go looking for early stage investors, oftentimes friends and family, for example, or, if they find an angel. And so there is a gap in the investment market for those businesses that are not VC fundable. And I think that's one of the challenges that a lot of founders face. And either you figure it out in terms of you go raise friends and family, or you end up bootstrapping and you figure it out that way, the hard way. You have your like consistent growth, for example, as you mentioned, like you might double, you might grow like at a very consistent, 15 to 25% year over year growth, for example. And eventually you get, private equity might come in and do like a minority investment to help you grow, and then grow to a certain stage, and then, exit at that larger amount. But there is a gap there. And that's why I think it's very hard for founders to identify themselves as not VC fundable. And I think there's another aspect there as well, which is like a lot of founders think that the problem is just capital. Hey, if you just pump more money into my business, then of course I'm going to, triple, double, because now I have all this capital at play. Now we've seen that also isn't necessarily true with all of these massive fundraisers that have been incredibly overvalued, money isn't always the answer. So those are kind of just a few thoughts that I have to share on that.
I mean, look, don't give away the secret blue ocean opportunity here. Yeah, there is a gap in the funding market for early stage private equity investors, right? If you will. That's a very interesting gap. That's all I'll say about that.
Woo!
So, but look, I think I definitely understand the challenge. I mean, you hit the nail on the head. And what I tell founders who are in that arena, right, which again, frankly, by a company count, is probably 80% of businesses and founders, right? It's more of the exception, honestly, to be in that kind of venture market. But for those 80% of founders, this is what I tell them is, first of all, it doesn't mean that you can't raise any VC. Okay, it means that a successful kind of mode, if you're in that kind of company, let's take a Warby Parker, just because I mentioned them, right? Sure. Or maybe a WeWork, right? It doesn't mean raise zero VC. I think it means being smart about the VC you raise. I said not a material amount, right? What you don't want to do is overcapitalize your business with venture, because you build up a liquidation preference stack that's very high, and venture equity is the most expensive source of capital. And sometimes it's hard for founders to kind of realize that, because there's not like an explicit interest rate associated with it, but that's materialized in the form of the very high growth expectations that the VC will have. And for any founder who's kind of been, raised too much venture and then realized that the sustainable growth rate for their company after that, post hoc, is not the triple, double, but 50%, then you know what I'm talking about, right? Because there's then tension between the VC on your cap table and you, and what's right for the business and what's right for the VC's portfolio, right? And there's all these, history is littered with examples like this, where it's like the VC is thinking, I need this to be $1 billion soon, or it's not worth my time, because my model, my portfolio construction assumes 50%, of my deals are going to go to 0 or 1x or something, right? I mean, the 1/3 rule of thumb, I think like Fred Wilson at Union Square was the first one to articulate this in a blog years ago, is like 1/3 of your portfolio goes to 0, 1/3, returns 1 to 2x, like 1/3 minus 2 companies maybe return 3 to 5x, and then 2 companies are like 10x to 100x, right? So like that's in the VC's mind. So if they're sitting with the founder and the founder's like, I can really only grow 50%, or whatever it is, they're like, and it's like a $10 million ARR SaaS company growing 50%, like that's not going to get you there. That's going to take too long to get to hundreds of millions of ARR. So what happens then, and the way this cost of capital is made tangible, is like the VC will spend less time with that company, be more reactive. Like the economically rational thing for the VC to do at that point is, if they have a company or two in their portfolio that is like a real VC winner, like they're going to double down, spend as much time with them as possible, and only do the minimal with the companies that are underperforming to kind of preserve the reputation, to be honest. I mean, again, this is opening the kimono, right? Like, you still want to have good founder NPS and not have, act like an asshole, right? But like, you're not going to be putting most of your effort into that company. That's what you want to avoid. So, if you raise a seed round or maybe a Series A or whatever, and then you kind of get to profitability quickly on that, that's one thing. The second thing is, I tell founders, this is kind of maybe a good segue into the narrative, which, the collateral, the deck, and all this kind of stuff, is like, be honest about, like, do the analysis that I mentioned, like what kind of company are you, what market are you operating in, and then be upfront and honest with that about with potential investors. So, if you're starting, like, as a hypothetical, if I was starting or counseling and advising a founder who's starting like a next, CPG company, like which again could be a successful business, but like it's not going to be, that's not a category that is in the venture mold,
right?
In 95% of cases, then I always tell people, have a slide that says like 3 reasons why you shouldn't invest, right? And I did, I'll give credit to Harry Stebbings, who posted about this before I did. And it's a good idea, right? So like in that type of slide, right, say like, you should not invest if you expect me to triple, double, we have to be aligned with what a success case is for a company that is creating, shoes or glasses or, something like that. Like, it's not the same as a company that is, creating a foundational AI model. Those are two obviously different things. If you're upfront about that in your fundraising, and even more powerful, if a founder screens and evaluates the VC to see if they buy into that, that's really powerful, because all of a sudden the founder has turned the tables on the investor, right? The default is that the investor is here, the founder is here, the founder is asking the investor for money, so they're lower status. That's kind of the default, unless you're like a celebrity founder or something, right? The cool thing is that you have some reversal. You take a perceived weakness, like you can't grow, or you shouldn't grow at the same rate as like a true venture company, and you flip it into a strength, and you level the playing field by saying, this is what success looks like for my company, right? And if you VC are going to have an expectation that I grow unsustainably, then I do not want you on my cap table. Thank you very much. It's not a good fit. Let's save everyone the heartache and end the meeting early, right? First of all, that's happened to me on the VC side maybe 5 times or less in my career. And whenever it does happen, out of like probably thousands of like pitches, it's always super impressive, because I'm like, oh man, like this person is not needy, is not desperate, like has options, has leverage. I mean, it's a very strong psychological signal, and it's also factually correct, and it's having the tough conversation up front, right? So I say all that to say that there are VC investors who are recognizing this gap and trying to do things differently, and are okay with a company that is not going to T2, D3, right? And they've been thoughtful about their portfolio construction to accommodate for that. And it is a very niche part of the funding ecosystem right now. And it's not like they're all explicitly categorized and easily findable. You have to kind of have the conversation. But there are firms like that. And so if you're upfront about that, then you can find the right partner, right?
Yeah. I mean, for all the people out there who have worked with me, you definitely know that I'm all about qualification, like, qualify people by disqualifying them. With any of the founders I work with, it's not just about the money. Like, is there alignment? Is there, personality match? Is there culture match? It's like so much more consideration. So I love that you brought that up as well. And I love that point about, having a slide in the deck that's like, if these things are true, you should not invest. And I think it's really important for founders to do it well, because I meet founders all the time that are like, oh yeah, we're not raising, like they'll just like tell investors that they're not raising, which is also great in terms of relationship building, just for the nature of relationship, but it has to be executed well. It can't be like, oh, I'm not raising, but also you're like desperate for money, like,
yes. It's got to be authentic. It's got to be executed well, 100%. But I'm glad you're also preaching the kind of disqualification and screening of VCs, because it doesn't happen enough.
Yeah.
Right?
Yeah. I'm always, strategic capital raises. We're not raising capital for, just because we want to raise capital. Especially for early stage founders, if you can find product market fit without looking for capital, if you can, run the numbers for the company and really make the company profitable before going to see capital, have a reason to raise the capital. Like, it's not just, I want to raise money because it's going to make my journey easier. And I imagine that, if I solve this capital challenge, then, everything is going to be honky dory. That's not what it's about. We have to like use it strategically. So, and for every stage, there are strategic uses of capital. So that's the second bucket. The third bucket that we talked about post like narrative with investors is actually structuring the capital raise, right? Or like approach to the capital raise. So what are things that you often see with founders there in terms of things that they might get wrong, questions that they may ask you, and just general insights around that bucket?
Yeah. So the most common failure mode is not targeting enough investors in your process, and then raising too casually without enough calendar density and urgency all at once, right? So I think probably the most common thing when I this is true, both the founders I advise now and also my portfolio company founders from past firms. It's like, okay, you're raising your next round of capital, send me like the list of folks you've been speaking to, and like, I'll help with the spreadsheet and all that. And almost always I get like 30, 40 names. And sometimes if the founders started having conversations, I might be having 3 to 4 conversations a week. They have a deck, they have like a data room. Look, I understand. I mean, you're running a company, you're raising the business. This is like a whole second job, right? And it's in some ways unrealistic to like do both, but like that is the reality of a founder. And by the way, another play for like, if your market structure doesn't dictate you to raise too much capital, like, then the benefit is you can focus more on the business, right? Because it takes a lot of time. But that's the most common failure mode. Look, there's always exceptions to the rule. If you're an extremely hot company or extremely celebrity, well-known repeat founder, like you can do that and like, and still be successful. But for like the typical founder, right? That's not going to be the most optimal way to do it. So what I tell people, again, I had a LinkedIn post about this too. I always like to start founders with at least 150 names of firms, right? And ideally, those 150 are according to desk research, right? In other words, like no calls, but just looking at like the firm's websites and whatever you can find online. You believe those 150 to be qualified leads, right? They invest at your stage that you're raising. So if you're raising an A, they invest in A's, invest in your sector, right? Like, if you're a hardware company and it's a SaaS firm that only does SaaS, like it's not going to be and so you have 150, desk qualified VC firms on there, right? If you start with that, and I'll kind of walk through like the high level of the process where you start with that, then what you're going to want to do is before starting your kind of fundraise, you're going to identify your intro paths to all 150. Right. And so this is a lot of work. I'm just like, I always caveat when I tell founders, I'm like, this takes a kind of ton of prep up front, especially in your first couple of rounds. But then the nice thing is if you raise multiple rounds, you can kind of reuse some of the stuff. But you find 150 intro paths. So maybe 30 of them, you already know it's first degree, and that's great. That's kind of the easy ones. But then if you have 120 firms who you don't know someone at the firm and you're maybe second degree, which is pretty common, then you have to go like, the most common thing is you look at LinkedIn, you're like, okay, who are my mutuals? And then you're going to, in most cases, you're going to have to take a guess at who your mutual is. Because a lot of times they might be connected on LinkedIn, but then if you ping your mutual, they're like, oh, I haven't spoken to that person in 8 years. I don't even have their email. Like that's not a good intro path. So you're going to put your 120 guesses, right, at your mutuals, and then you're going to ping all 120 of those first degree mutuals, and you're going to ask them, do you know X investor at Y firm well enough to make an intro if I were to send you an email with context to forward, right? And like of those 120, 60 might say yes, great, check the box. 60 are going to say no. So then you got to have a second guess at different mutuals for those 60, and you repeat that process until you have 150 verified intro paths. Okay. Once you have that, then now, and we're assuming you've kind of done the work on the deck and the financial model and the memo and the email blurb with the bullet points and all that stuff, right? That's all ready. Because then what you're going to do is you're going to, in like a day or two, send 150 emails, right? Just direct ones to the ones you know, and then forwardable ones to the ones that you need an intro to. The purpose of sending it within such a tight time frame is that you want to set yourself up for calendar density, right? And I borrowed that term. I can't remember his name, but he's another guy who's like an ex-VC. I think he's at Greycroft, and now he also advises founders. And just check him out. Again, I can't remember his name now, but calendar density is super important, right? And because if you do it that way, then you set yourself up to have, 70, 80 first calls within a week or two, right? And that is not just important from like a funnel conversion numbers approach, of course, because you always want to set yourself up to get at least 2 term sheets or, get oversubscribed if you can. It's not always possible, but that's the idea. And for most companies, by the way, that are venture backable, like if they don't get oversubscribed, it's because their narrative or their process wasn't good enough, right? And not because their business wasn't good enough.
But you'll figure it out along the process anyway if you get that calendar density. Like everything will shake out and fall into place if you can make that calendar density happen, because you will be getting so much feedback, and the feedback will have patterns, and you'll know where you're falling through the cracks. That's also why the calendar density is incredibly important. I love that you brought that up. I'm literally telling founders all the time, go have 1,000 conversations. Like, how many investors have you talked to in the last 30 days? If it's not like at some huge number, you're not doing enough. Like, that's just the nature of it. So I love that you brought that up. In the interest of making sure that we get all of the 4 buckets, because we're nearing the end of time for the podcast, what's the main point you want founders to get with respect to the 4th bucket?
Yeah. So, I mean, on the 4th bucket, I would say term sheets are, what I want to focus on. And I think my maybe controversial but high conviction opinion on this.
Hot take.
Yeah, hot take is like, and look, so my hot take is that founders should really know term sheets, right? Like, I've met a lot of founders who kind of think, well, my lawyer knows the term sheet, so I don't really need to know much about it. He or she will tell me what I need to know, right? And like, that's a good way to get fleeced in a deal, right? Because look, if you have a good lawyer, what I expect from a great venture lawyer, right, like yourself, is obviously tell me about the legal risks that like I should be aware of, and tell me what is market from their perspective doing, deals, right? Because they do a lot of deals. So, but a lawyer is not the same as an investor. There are certain things and there's certain ways that VCs negotiate with founders. Again, there's a lot of information asymmetry that VCs do dozens and dozens of deals. Founders will do even like repeat founders, maybe, a dozen or less. And so there's certain like tricks and things that go into term sheet negotiation that if you're not aware of them and you're not able to understand, process, and react in real time during a call, you are going to not get the best deal.
Yeah, you'll give up a position.
So it's not a thing where like you can be like, okay, the VC wants this, and then I don't know enough to react live, so I go talk to my lawyer, and then I cut like there's going to be a 30-minute call or 45-minute call where you're negotiating in real time. You need to know enough to do that well.
What's an example of one trick, for example?
Oh, the easiest one is option pool shuffle. Yeah. Right. I mean,
I did a post on that.
Yeah. I mean, this is, there's a lot of good articles about it. I've done webinars on it. It's part of I have a course on term sheets. It's a big part of of that. But like, just really quickly, I know we're close on time, right? If you refresh the option pool before the VC investment, that only dilutes the founders and it decreases the pre-money valuation. If you create the option pool after the VC investment, it dilutes the founders and the VCs and it decreases the post-money valuation. And so, what you want to do as a founder is look at the term sheet section. It's usually called pre-money valuation, and see, okay, does the option pool get created before the investment, and do all the convertible securities, the safes and the notes get converted before the investment? Surprise, they almost always do. That's market standard. And so just know that the pre-money valuation, that headline valuation that's in the term sheet, is not actually correct. You have to work with Omeed and calculate what the real or effective pre-money valuation is. It's not 10 million, it's probably 8 or 7, right? That's a fully diluted pre-money valuation. If you understand that and can kind of do some back of the envelope math in real time, the order of the option pool and how big it is essentially a valuation negotiation. So if you understand that, treat it as such with the venture investor. What I always recommend is like, don't ask them to, create the option pool after the investment, because there's reasons why VCs hate that, which we probably don't have time to go into, but just say like, look, yeah, we'll do the option pool before the investment and all that's fine. But like, let's just do a higher pre-money. Instead of 10, let's do 12, because I know the real pre-money is not 10, it's 8. So like, and a VC, again, when founders do that, I'm like, okay, the founder knows what they're talking about. Yep. That's reasonable. Yeah, we'll bump the pre-money.
Great advice. And for all the listeners out there, go take Morgan's term sheet training as well. Morgan, thanks so much. This has been really amazing information. We are here at time, and I want to make sure that we end timely. There's been a lot of really good information here in the 4 buckets. For all the listeners out there, Morgan's contact information, his LinkedIn is all going to be in the show notes. If there are any resources that you want me to include as well, Morgan, I'm happy to. For example, that term sheet training. And thanks so much for joining this week, Morgan. I really appreciate it.
Thanks so much for having me. It's super fun, and we'll have to do this again.
Absolutely. Would love that. And for all the listeners out there, thanks for listening. As always, subscribe, share, like. Let us know what you got from the episode in the comments. and we'll see you next week.